Despite the fact that we did see the failure of First Republic, the street is still betting that the Fed is going to keep going and raise rates. The latest Fed funds future showing a 90% chance of a 25 basis point hike this week.
The most important Federal Reserve meeting of the year, until the next one, is happening today and tomorrow, with the results coming in tomorrow. And as an investor in cryptocurrency, I need you to be prepared. Buckle up, folks. It's time for another FOMC meeting, and all eyes are on the Fed's interest rate decision coming out tomorrow. Here's what to expect from the presser and how it could impact the economy. Most economists believe that the Federal Reserve will raise interest rates by 25 basis points at the end of the May 2nd, 3rd FOMC meeting, which will increase the federal funds rate to a range of 5 to 5.25%. And what exactly does that mean? Well, this would bring us to the highest interest rate since 2006 and the 10th consecutive rate hike from these FOMC meetings. While some policymakers may abdicate for more rate hikes beyond May, many, including myself, think that a consensus will form around a wait-and-see approach. So the market is speculating that we'll get one more 25 basis point bump tomorrow. It will be followed by a pause, a hold, not a pivot, but a pause.
Another bank failure here this year. Do you think it's going to have any impact on what the Fed does on Wednesday?
No, I really don't. I think what the Fed's looking at, if you just go back to the minutes for the March meeting, you can kind of, dive in a little bit into the inner thinking of the voting members, is they're looking for any kind of strains or stresses in the funding markets. And quite the opposite. Actually, the funding markets are beginning to show some signs of alleviation of the pressures that we saw in March following Silicon Valley Bank and Signature Bank. So as long as I think the Fed sees the plumbing, for lack of a better way of putting it, is in order, that they'll give us that one more quarter point rate hike.
And let's be watching tomorrow. I'll be watching. I'll make a video. I'll let you know what happens. But let's be listening tomorrow for the language Jerome Powell uses. I expect Fed Chair Jerome Powell, J. Powell, to emphasize 3 crucial points during the news conference. Number 1, inflation remains too high for comfort, as seen by the latest CPI and salary data, necessitating the Fed's continuation of a restrictive monetary policy stance. So inflation is still too high, so expect a bearish rhetoric on that front. After all, we're not seeing any noticeable big change in inflation despite the ultra-aggressive and consistent rate hikes. Number 2, crucial point that Jay Powell will probably emphasize, that the U.S. economy and labor market are slowing to below trend growth rates, as seen by poor consumer spending momentum, reduced hiring, and increased layoffs, which is exactly what the Fed wants to see in order to help curb inflation. So each passing month, the labor market, i.e. the U.S. economy, is slowing more and more. And that may sound bearish, but actually to Jay Powell, that's bullish. That would be a reason that he can be more dovish. He's trying to come as close as he can to breaking the economy without actually breaking it, time will tell, and get those unemployment numbers up to curb inflation. He likes that. And number 3, crucial point Jay Powell will probably bring up, I expect quantitative tightening to continue, no relaxation for the time being. So although we saw a version of quantitative easing start back up again when Silicon Valley Signature Bank failed, the speculation is Jay Powell will not continue that, even though we just saw First Republic Bank, major bank in America, collapse essentially. They just got bought out by JP Morgan. The expectation is quantitative tightening will continue. In summation, the economy today is showing signs of poor health, with persistent high pricing for goods and services, high interest rates, and now tightening credit restrictions combined with recent bank failures again. These factors are likely to result in a minor recession by mid-year.
And we hear it all the time. Are we headed towards a recession, especially those wondering how they should position their portfolio? And while the consensus seems to be that we are heading towards a slowdown, whether technically it is a recession or how severe of a recession, that's where you get some differing opinions. Now, one of the traditional definitions of a recession looks for at least 2 consecutive quarters of negative GDP growth. And depending on the chart you consult, when it comes to the data, well, the results may vary. widely, really. You're looking at factory orders. Those have seen a steady decline since the pandemic highs we saw back in 2021. Then while we look at wage growth, that's still elevated. Indicators of sentiment, those are contradictory. And with low unemployment also indicating a tight labor market, though it has been slowing. And Wall Street's fear gauge, the VIX, that's at one of the lowest points in the year. But then what about the corporate side? What are companies saying? We're in the midst of earnings season right now with really a mixed picture. You've got UPS, a logistics specialist that has spoken about lower volume on declining retail sales. Intel still on the decline, showing weakness in chip demand. But then you've got some bright spots. You had Uber reporting, citing strong demand for rides and food delivery. And big banks, even despite those headlines that we've been hearing of layoffs at Morgan Stanley and other places, they're still saying that they are prepared to weather a possible recession. Now, here's what Citigroup CEO Jane Fraser said during an interview with Yahoo Finance at the Milken Conference. Take a listen.
We do think we are probably heading into a recession at the back end of this year. There is likely to be credit tightening. There's some stresses ahead, commercial real estate and the like, but this should be manageable.
So really, the severity of the recession, that is where you do get some differing opinions. Now, even Federal Reserve economists, they predict a mild recession is likely sometime later this year.
Now, what's happening in crypto today is even bigger. But I do just want to say before that what the market hates more than a hawkish increase, I would say, is uncertainty. Meaning, in my opinion, a 25 basis point rate hike from today is already priced in. The market's expecting that. If they go more than 25 basis points, which I don't see happening because of we literally just had another huge bank failure, that would be ultra bearish to me. The market, I think, would react as such bearish. Now, if we just pause, that's by no means a pivot, but based on what the market's expecting, that would be super bullish in markets. And major announcement, Coinbase International Exchange has just launched amid SEC crypto crackdown in the US. So this is a global derivatives platform, so not for retail. It's actually specifically for institutional investors wanting to trade derivatives. And the CIE, Coinbase International Exchange, CIE, will start trading by listing Bitcoin and Ethereum perpetual futures later this week. And by the way, for all investors in the United States, we're not invited. Thanks, SEC. Coinbase stressed that direct access trading on CIE is available to institutional clients via APIs in eligible non-US jurisdictions. These products are not available to retail customers at this time, Coinbase stated. And speaking of compliance, LOL, let's talk about PEPE. PEPE token soars to an over $500 million market cap as meme coin fever grips crypto traders. And a big reason that we're watching this pump continue, actually, is because PEPE derivatives will be listed on BitMEX with up to 50 times leverage. That's incredibly dangerous. And I'm not invested in PEPE, but it's interesting because we can check on the blockchain and see the actual amount of people that are. And according to Ethereum Block Explorer Etherscan, PEPE has around 75,000 holders with several wallets, excluding centralized exchanges, holding in excess of $5 million worth of the tokens. And keep in mind, there's a huge difference between what, for example, CoinMarketCap says something is worth and what you can actually sell it for. Just because this is listed as a $500 million market cap doesn't mean the liquidity is there. For example, while hype around the meme token continues to build, some early investors have been cashing out. One trader sold $2 million worth of the token, but they ended up losing about $350,000 as they were hit with 25% slippage due to minimal liquidity. So incredibly risky. Please be careful. And that is the video. My name's Austin. Like always, see you tomorrow.